Welcome to the Purpose-Based Retirement with certified financial planner Casey Weade. Casey is the president of Howard Bailey Financial.
Whatever risk you face during your retirement years, we've got a plan.
A published author and radio host.
It's not how much we make during the good times, it's how much we keep during those really bad times.
His advocacy for retirees and pre-retirees has made him a sought-after speaker and trusted financial leader.
And putting a real plan together.
This is the Purpose-Based Retirement.
Good to see you again. I am Lee Kelso here with Casey Weade and Marshall Johnson, both of them certified financial planners with Howard Bailey Financial. You know, those of us who are looking ahead to retirement typically have a plan A and a plan B in mind. Well, today, Casey wants you to consider Plan U, an unorthodox way to think about managing your money in retirement. Then a viewer 5 years into retirement asks that with the market on such a roll, can he afford to be conservative in his investments? That may be of interest to you. And in our Financial Toolbox segment, Casey takes a look at just exactly what is one of the most misleading charts used in the financial industry. So a lot to talk about today, but let's get started with that whole Plan U thing. When you talk about unorthodox thinking and investment, I always want to know more. So what's the background on this?
Well, we're talking about a seminal work that was actually done by Dr. Weade, a pretty well-known financial planner, doctorate in financial planning, and he did his work on the equity glide path that we take on our way into retirement. How much equity exposure do you have on your way into retirement? And there's a lot of different schools of thought on this. There's the typical Plan A, which is the plan that kind of takes us through our accumulation years, and that's basically just walking you through something that maybe you did with your accumulation advisor. Here's a risk tolerance questionnaire. You figure out what your tolerance for risk is, how much time you have, and then what your rebalance schedule is going to be, and that kind of becomes your plan for getting yourself to retirement. And then there's the Plan B for retirement, which is really taking that equity exposure and just subtracting it using the rule of 100. So you take your age, put a percentage behind it, and that's how much we have in fixed income, and we reduce it a little bit every year as we continually age and get closer to retirement. Even through our retirement years, we continue to reduce that equity exposure and add more fixed income exposure. And Dr. Pfau did this for the Journal of Financial Planning and found a much more consistent way and a better way to get more results and more income out of your portfolio than we can for some of these traditional methods, the Plan A's and Plan B's. And it's a little different. However, it's something that we've been doing for years. And I just read this article here when I was getting my retirement income certified professional designation a couple of years ago. And when I went through that process, I read this article and I said, wow, that's something that we've been doing for years. And it just seems so obvious that when we step into retirement, we're reducing our equity exposure, and then over the years into our later retirement years, we're actually adding some equity exposure to the portfolio, but we reduce it at the most important time, the time that we cannot afford a major loss, and that's the onset of retirement.
So that's where the U comes from. You reduce that exposure and then gradually increase the exposure.
Exactly. We're reducing that exposure, and we're maybe 100% equities when we're 20 or 30 years old.
Right.
And we can carry that equity allocation for a long period of time until we get close to retirement. We start to reduce it, and we reduce it quite dramatically as we step into retirement. But most of the people I see that walk into our offices are still 100% equities or maybe 80% equities. You're still taking a significant amount of risk. And I think it's important to point out that a lot of the folks that I see, I had a gentleman that just the other day said, I think I'm around a 3 or a 4 on a scale of 1 to 5 on risk, about a moderate growth portfolio, and he hit it right on the head. He was sitting in a portfolio that was about 20 or 30% fixed income, and he said, that should be less risk than the overall market. But when we look at how his portfolio's performed relative to the S&P 500, he's underperformed the S&P 500 and still lost as much in the S&P 500 during the financial crisis like 2008. So just because you add bonds into the mix and you add a little bit of bonds, 20 or 30% or even 60%, doesn't mean, depending on the type of bond and fixed income we use, that you're actually reducing your risk. And we can't afford a travesty in those first 5 or 10 years. We can't afford to see that portfolio lose 20 or 30% and you still depend on that for income. income. Step into retirement and you don't need it for income, then great, stay 100% equities, stay 80-20, whatever it might be. But if you need the money, which I know most retirees say, I need the money, then we need to look at this problem differently.
You said unorthodox. You like to look at something from a different view. This is unorthodox from that Plan B perspective, where a lot of people use the rule of 100 to say, okay, if I'm 60 years old, I should have 60% safe, and then it declines as they get older and older. Where they get out to 85, then they have very small amount of equity exposure. I met a gentleman this week that's 75, 76 years old. He said, Marshall, I think I'm just taking too much risk, because he's using that old rule of 100. He's saying, I'm probably 75% equities. And what I told him was, using that U shape, you can actually take that much exposure later in life because of the research that's come out on this thing.
So the idea here is that as I get later in life, if I have enough resources, if I have enough of a nest egg to get me through to the end of my life, why not take some risk and grow what's there?
Nothing wrong with that. And what we typically do with the people we work with is we're going to guarantee your first 5 to 10 years of retirement income. Sometimes we'll guarantee a lifetime of income, but that can be expensive, and not everybody wants that inflexibility. So let's take the risk off the table, give you an anti-anxiety pill for the first 10 years of retirement, so that we know if the market does take a dive, you don't have to take a dive in your income that you need to meet your expenses every single month. So as we guarantee that first leg of income, we may have some other legs that contain more equities, and we're spending down some of that fixed income. So in a sense, we're not really increasing the equity exposure, but we're spending down the fixed income, which in return increases the overall portfolio's allocation of risk, which is something that's statistically good for us to do historically. However, if we look at the market's levels today, and we say today we're in a very expensive market, this is one of the most expensive markets in history, then it makes even more sense rather than just looking at all the years of the market. And I want to share a chart with you that shows us exactly that. This blue line here is the 5-year average valuation of the market. And as we can see, when that valuation is very low, like it was, say, in the 40s and 50s, we can say that that's a good time to buy into the market, and we were able to ride this red line, which is the S&P 500, back up. However, if we bought into that market in the 60s, then we would have been buying a very expensive market, and the following 20 years we would have seen a negative return on our portfolio. Now, a great time to buy in the market would have been the 70s and 80s, when we started at the onset of the biggest bull market in history. From 1982 to 2000, we had a 17-year period. The market's up over 1,000%, and then it got very expensive when we got to those tech bubble days, and 9/11 occurred, and we saw the market take its consequent dive, and we saw that 10-year plus one, the lost decade, occur from 2000 to 2010, 2011. And now we find ourselves again seeing this hump in market valuations, and with market valuations being that high and the S&P 500 being just as high with it, we know we're buying into an expensive market. So if you're walking into retirement without a real plan, without a real strategy, just hoping that everything's going to work out, then you may be sorely disappointed when we see the market's returns over the next 10 or 20 years be negative or be flat over that period of time. You need a real plan that can protect at least a portion of those funds, if not all of those funds, at this time, and allow you to increase your equity exposure as we find real value in the market's future.
And let's help you out with that. So for the next 5 callers, we're going to custom design for you an easy to understand financial review. No obligation or cost for this initial review. And in this review, we'll run a fee report to help you untangle what it's costing you to work with your current planner or advisor. We'll perform a tax analysis to show you how you could potentially reduce your taxes, conduct a portfolio risk review to uncover unnecessary risks that may be lurking in your nest egg allocations, and create a customized lifetime income plan using proven strategies and techniques that really could turbocharge your retirement. So we're going to take all the guesswork out of financial planning for you. For the next 5 callers who call right now at 482-9559, it's a comprehensive financial review with no obligation. 260-482-9559 is the number, 482-9559. We're back with questions from viewers. Stay with us.
It's your retirement. How will you live it? How will you be remembered?
Will you be able to send me an invitation?
Will you be there for my ball games?
Will you teach me your values? You'll be able to play with me. Oh, help me go to college. How will I remember you?
You need a plan for retirement to create the lifestyle you've always dreamed of. The first step is to tune into the Purpose-Based Retirement Radio Hour with your hosts, Casey Weade and Marshall Johnson, every Saturday morning at 11 and Sunday afternoon at 1 on 1190 WOWO and 107.5 FM.
Welcome back. Time for us to talk to some viewers today. We're going to start with Bud up in Tri-Lakes. Bud, go right ahead.
We retired 5 years ago, and the market has treated us very well, although we needed it since we're spending almost 7% of our portfolio for income. Now I'm getting a little uncomfortable with the market, but my advisor says I can't afford to be more conservative. My question is, how can we protect ourselves if we can't get more conservative?
Bud, wonderful question. I appreciate that. You know, the problem is saying 7% today assumes that things are going to be linear going forward. Hey, the markets are going to go up, they're going to go down, that balance is going to shrink, it's going to expand. I think the real problem here is you don't have a plan for the worst. You've got a plan that's hoping for the best, relying on those stock market averages. Really what we'd like to do is take a step back. You can afford to take risk. As we mentioned in the first segment, you can still take risk. It's just you can't take risk with that money that you absolutely need for retirement.
You know, and I'll say 7% is a significant amount of the portfolio, and with interest rates being as low as they are, it is going to be difficult to set very much of the portfolio aside in a fixed income asset, you know, especially, as I said, with low interest rates. However, that doesn't mean that, as we often say, well, let's guarantee the next 5 or 10 years of your income needs. Well, what if we just take care of the next 1 or 2 years? And on average, the average recession is only lasting a couple of years. So if we have a couple of years of cash set aside in a safe place, that should be a big enough buffer so that we can continue to take a larger equity allocation with those other assets. So it is something that is possible. You just may have to look at it in a different way rather than just saying, you know what, I've got this portfolio of stocks and bonds and I'm just going to sell 7% across the board of all these different mutual funds, which is what most people do. They get their portfolio, they hand it over to an advisor, he charges them 1-2% a year to manage it, and then when you want income, they liquidate a little bit of every one of those individual holdings, or it's maybe in a couple mutual funds, and they're selling out of each one of those individual holdings. You're selling assets that are high, that have risen in price, and you're also selling assets at low prices that have fallen in price. It makes a lot more sense to be more selective and dynamic at this time in your life when you have the opportunity to say, this is my fixed asset, this is my equity asset, and we choose which one of those assets we're going to sell at the right time. So we're not just selling at a flat level across the entire board of all of your holdings. Another thing that you can do is you can carve out a portion. I had a gentleman and a couple I worked with that retired from, I think it wasn't NIPSCO, it was NiSource. Yeah. Okay. So retired from NiSource a number of years ago, and they were spending about 8% of their portfolio, and we had a similar issue. What we did is we carved out a small portion of the portfolio, about 30% of the overall portfolio, so it was about $200,000 of $700,000, and we put that in a fixed indexed account that gave them 75% exposure to equities. Now, they might get 100% gains, you might get 100% gains in the other part of your portfolio, but what if we only get 60 to 80% of the market's gains on this other portion, but it's principal protected? And that's a great way in this low interest rate environment to get your fixed income options up, to get your returns up on that fixed income portion, is to put it in a place where it can't lose value, but you still get a significant portion of the upside.
And it buys them time, and that's the whole point with the stock market, is you need time to go through those. So take a cue from Mick Jagger and put time on your side, right?
Nice. Bringing a Jagger quote to the show. Connie from Bippus, you're up next. Go right ahead.
I find risk to be a bit of a nebulous concept. I want to make money, but I don't want to lose. How do you help your clients grasp this concept?
Well, I can tell you from something that we say in almost every one of our meetings. I've got a couple of Marshall and I sat down with earlier this year, and when we had I think it was our second meeting. After our first meeting, we stepped in our second meeting, and they were kind of struggling with how much risk they should have. They were in 100% equity exposure portfolio. It was 100% individual stocks. And we asked them a question. We said, let's take up the value of what you have and do this for yourself, okay? I want you to do this for yourself. is take the value, whatever this value of this portfolio is that you have, your IRAs, your investments, your non-qualified accounts, whatever the investment assets that you are, take those things and double them in value. If those things double in value, does that change your way of life? Are you going to drive a different car, live a different lifestyle, go to different restaurants? Probably not, but maybe so. Now, what if we take that same asset though and we cut it in half? Now, if we cut it in half, does that change your life? Maybe it changes when you retire. Maybe it adds a little additional stress to your life. That is a question that I think really puts risk in perspective.
All right. We got to roll ahead here. Let's get to Forrest in Fort Wayne. Go right ahead, please.
My broker says retirement income annuities are bad. My question to that statement is, why?
Yeah, hey, it's a great question. There's a lot of tools out there today. You know, you go back to the 50s, Baskin-Robbins was just, becoming popular. They had 31 flavors. My goodness, that's way too many choices, says the mom and pop that only serves vanilla, chocolate, and strawberry. Well, what if you want cotton candy flavored ice cream? Does that mean it's bad? Well, maybe to the guy that only has chocolate, vanilla, and strawberry, yeah, he's going to think it's bad. He's going to think Baskin-Robbins is awful. Right. It's all about choices. Be aware. It sounds like you need a real education. It's not about a tool being right, wrong, or indifferent. There's a lot of different tools. You just need to figure out if it's right for you.
You just have to work with the right guy that has all those different flavors, right? So that they can really provide us with the education so that you can make that decision. I always provide the people I work with through 3 different plans. A guaranteed income plan where we can use things like retirement income annuity, all the way to something that puts all those assets remaining at risk, but different levels of risk, and then a blended approach. You can see the upside, you can see the downside, the fees, the expenses, the strings that are attached, and you can make that decision for yourself. It's up to you. It's your money. It's not mine. It's not your broker's. You need to sit down with someone that can provide you a real education so that you can make the best decision for your financial future.
And the first step to doing that, I hope, is being one of the next 5 callers. We're going to offer to custom design an easy to understand financial review. No obligation or cost for this initial review. We're going to run a fee report for you to help you untangle what it's costing you to work with your current planner or advisor. We'll perform a tax analysis to show you how you could potentially reduce your tax burden. We'll conduct a portfolio risk review to uncover unnecessary risks you may be taking with your nest egg, and create a customized lifetime income plan using proven strategies and techniques that really could turbocharge your retirement. All of the guesswork, we're taking all the guesswork out of it for you. So for the next 5 callers who call right now, 482-9559, it's a comprehensive financial review with no obligation. 260-482-9559, 482-9559. Here's our question of the day. How many years does the average pre-retiree have to save for retirement? Is it just 10 to 15 or 25 to 30? Lots of choices. Which one's right? Casey has the answer next.
Hi, I'm a certified financial planner practitioner. Are you one of the lucky few that will still carry a pension into retirement? Is your company offering you a buyout or a lump sum pension option? If you're seeking independent, unbiased advice from an advisor that can inform you about all of your options, then look no further. You deserve a lifetime of financial confidence due to a lifetime of income. And at Howard Bailey Financial, it's our goal to help you achieve that. If you'd like to see how a CFP professional can best serve you, give us a call today.
You need a plan for retirement to create the lifestyle you've always dreamed of. The first step is to tune into the Purpose-Based Retirement Radio Hour with your hosts, Casey Weade and Marshall Johnson, every Saturday morning at 11 and Sunday afternoon at 1 on 1190 WOWO and 107.5 FM.
In the break, we asked our question of the day. It had to do with how long does the average individual need to save for retirement? And Casey, which is correct?
Well, Lee, this question has to do with time. How long do we have to endure the market's ups and downs? The answer might surprise you. The answer is C, 20 to 25 years. Now, why is that? Why does the average individual not have 30 or 50 years, which is typically the numbers were quoted by our brokers, by your financial advisor, talks to you about what kind of returns you can expect from the market, 6 to 10%. Well, that's over the last 100 years of anywhere from 10 to 30-year rolling averages of the market. However, there are time periods that we could go through of 20 years, 25 years, and more that we've seen in the past where the markets have been flat over those extended periods of time. 20 to 25 years is because typically we go to college. After college, we get a job, we pay off our student loans, you get married. After you get married, you have kids, then you have to put the kids through college. Now you reach the peak of your earning years, the kids are hopefully out of the house, and now you really start socking away the majority of those dollars that you're going to have during retirement once you actually get to that point. And it's it's all about time. How much time do we have? Maybe you're stepping into retirement and you're wondering if we're at a good time to take on additional risk because we have 20 or 30 years to invest. But again, it's all about the time frame that we're looking at. And I want to share with you the world's most deceptive chart. And the way that I came across this, I had somebody email me. They said, Casey, you're always talking about being very cautious in that financial red zone. When you reach that point of retirement, reducing your equity exposure, or reducing your risk, because it's not so important how much of the upside you get as long as we minimize the downside. It's about minimizing the downside risk and making sure we get as much as the gains as we possibly can. But more importantly, again, it's not about how much we make, it's more about how much we keep. And then they sent me over this chart and said, well, this chart seems to argue against your point. And this is something that's been all over the internet for a number of years. It seems to fluctuate from time to time as we add a few years, subtract a few years, and brokers like to use it as a selling point. Wall Street likes to use it as a selling point to get you invested in the market. That's how Wall Street makes their money, is to keep you invested in equities all the time. If we take a look at this chart, it puts everything, it looks, those red periods of time are the bear markets that we've experienced. The blue markets are the bull markets, or extended periods of time of increasing equity prices. And when you put it in that perspective, we see, well, the recessions and the bear markets don't really seem all that bad. Anywhere from negative 19% to negative 47% or 50%. So negative 20 to 50% versus these bull markets that are up anywhere from 30% all the way up to 815% and more. Those returns in those really good times seem to more than make up for those very short periods of bad times. The problem here is twofold, and we're going to get to that in just a moment. But one of the biggest issues is not recognizing where we're at. So are we on the onset of a major bull market, or at the onset of a major bear market? What kind of returns can we expect going forward? If we look at 20-year forward annual returns from PE levels, PE means what's the value that we're paying for something. It's not about the price that we pay for something. The price is just what we're paying. The value is what we're actually getting. And if we look at the price over the earnings of the stocks that we're buying today. Sometimes you might just be buying stocks, not really realizing you're actually investing in a company. That's what you're doing whenever you buy an individual stock. If we buy a company that costs us $2.5 million and they're earning $100,000 a year, it's going to take us 25 years to break even. If we buy a company for $3 million and they're making $100,000 a year, that's a 30 PE ratio. It's going to take us 30 years to break even. Today we find ourselves in this 25 to 30 area, which shows us historically those returns in that 25 to 30 on a PE ratio average somewhere between -1 to positive 2.5%, 3% per year moving forward. And that's all due to those major pullbacks that we experience when market valuations get this high. It's the math, it's the numbers. If we move from $1,000 to $2,000, that's a 100% return. $1,000 to $3,000 is a 200% return. $1,000 to $8,000 is a 700% return. We say, great, that's fantastic. However, what if we experience a loss? So now we move from $1,000 to $8,000, we've got a 700% return, and we just have a 50% loss. Well, if we look at that chart that we saw earlier, it kind of looks like, well, that 700% return just turns into 650%. But really our 8,000 is now going to 4,000. And now what's it going to take us? Now we're looking at a 300% return instead of 700%, and it's going to take 100% just to break even. If we take this another step and start to look at this not in percentages, but actual dollar values or actual points that the S&P 500 moved during those major times, we can see that on an inflation-adjusted basis, we will see that, for instance, from 1920 to 1929, we saw that the market was up 352 points, or 400%. However, from 1929 to 1932, it was only down 80%. However, that's a 352-point loss. We're going to see that a lot of these bad years
wash away the entire gains of the previous bull market. Again, if we just look at it in percentage basis, we see that, well, these returns are so good. This period from 1920s again was up 400%, only down 80% for the following years, but that 80% washed away all of those gains from 1920 to 1929. This is what really puts it in perspective when we look at the actual points that get moved negative or positive. And now we see just how deceptive that initial chart, just focusing on percentages, really is. We're seeing that those gains in those bull markets are often entirely washed away by the point losses in those bear markets. And today we find ourselves here with a 1,415 point gain. Previously, when we had an 1,800 point gain, we saw a 972 point loss, a 675 point gain, a 900 point loss. Now we're at 1,400 points. What's the next year or the next 5 or 10 years really look like? We can see that on a bar chart is going to reflect that same exact thing, being these blue areas here is the percentage gain or loss in the market. And this really shows us how really illustrating this is very deceptive on a percentage basis. If we look at 1900 to 1920, we saw a period of time that the percentage gain and the point gain loss is about the same. But the following year, we see that percentage gain is not a real representation of what the market really moved over that period of time. So you have to ask yourself these questions. How much time do you have? Do you have 100 years? Do you have 30 years? How much time do you have to continue to invest in a market that may be overvalued? And is this time really different? We look back over the last 10 years and you might be saying to yourself, the market's done so well, maybe it can go on for another 10 years. Maybe we don't have to go through a major bear market like we did every 7 to 8 years over the last 100 years. And I'm promising you that this time really isn't different. It might be a couple more years, it might be a few more years, but inevitably everything works in a cycle. And you have to ask yourself if you're prepared for that cycle to change the next time around.
So Casey, talk to me about what you think is the first step to prepare. Obviously, you need to understand your risk.
Yeah. You need to understand your risk and you need to understand how you're allocated. You need to understand if you have real value, because we can put a dollar valuation or a percentage valuation. We can show you exactly what kind of holdings you had, if they're overpriced, if they're underpriced, are you getting good value, and what returns you can expect over the next 6 months, over the next 2 years. Within a 95% confidence interval, we can predict what those returns are going to be to the upside and to the downside, and we can stress test your portfolio to tell you what the net effect is.
And the first step in that path is for the next 5 callers, we offer you a custom designed, easy to understand financial review, no obligation or cost, where we'll run a fee report to help you untangle what it's costing you right now to work with your planner or advisor. We'll do a tax analysis to show you how you could possibly reduce your taxes, conduct a portfolio risk review so that you can understand, are there any unnecessary risks or exposures you are taking with your nest egg, and then create a customized lifetime income plan that uses proven strategies, proven techniques to help turbocharge your retirement. It takes the guesswork out of financial planning for you. So for the next 5 callers, you dial right now, 260-482-9559, a comprehensive financial review with no obligation. 482-9559, 482-9559. Hope you'll call now and hope you will see you next week.